All right, our last speaker will be Tong Yu.
Hello, everyone. Thank you. First, thank you to the conference committee for including my paper, and very honored to be here. So my name is Tong Yu. I'm a assistant professor of finance at Tsinghua University in China. And so I know this is like a research conference. We also have a lot of other audience, broad audience, like academic regulators, policymakers, and also community bankers. So I try my best to tweak the slides a bit to make them more accessible. But if I lost you in like somewhere in the middle, don't worry. Just to remember the last few slides, they're the key takeaway. Yeah, so that's okay. The usual disclaimer applies because I used it to work at the UK Financial Conduct Authority. Okay, so this paper is about open banking. So why open banking is important? Well, data and collateral play crucial roles in small business lending, right? So when the small business works into a bank, they want some credit, and the lenders typically assess firms' creditworthiness by looking at the data the customers or the small business provided, right? But this data is usually less extensive because due to some regulatory requirements, the small business don't have to prepare extensive financial statement, right? And also, this data is outdated because the financial statement in last year is not a good indicator for the operations in this year, right? And also, it's very costly to access the data because usually the bank financial data of the firms is usually locked away with the bank that provides the firm's bank account, and therefore it's not widely shared. So this creates an information asymmetry between small firms and potential new lenders, forcing small firms to rely heavily on collateral to secure loans, right? But there's also another problem, right? Unlike larger firms, small firms often lack physical assets like real estate to serve as collateral. So what they have is usually they usually have loads of current assets like inventories, accounts receivable, and these assets, they are volatile and also hard to track, right? So this leads to collateral constraints, limiting the access to credit, like the loan get declined, and also hindering their growth. And in this paper, I started a fintech innovation called open banking. Open banking means it allows bank customers to share the bank transaction data with everyone else, like third parties, like the fintechs, like the other banks or community banks. And so what is open banking specifically? And the data, or what is the data flow out of open banking? So basically, the data transfers from the banks to small business, and then the small business have the data and then can share it with the new financial services providers like the community banks, right? So this is not just data sharing, it's beyond data sharing because it is the shift of data ownership. And what exactly the data I'm talking about on open banking? Well, definitely it's not the financial statement data because that is low frequency data, right? It's like annual report. Also, it's not the credit bureau data, like the credit history or credit record data, because that is middle frequency data. What I'm talking about is the transaction data. It's high frequency data. And to give you a concrete sample, so this is a snapshot of a consumer's transaction record in the system. So you can see every transaction made by the consumers. So it wouldn't surprise me, it will have the same pattern for the small business. So from the small business transaction record, we can see the turnover of the inventories or account receivables and other cash flows, right? So this bank financial data can provide a rich picture of the operations and financial situations. And also open banking shifts the ownership of the data from the banks to the firms, allowing them to share it directly with the third parties. And what we already know about open banking is that open banking helps small firms to access more credit or to have built new lending relationships. So that is from my course paper with Tanya Babina. That paper is already published in Journal of Financial Economics. But what we don't know is the underlying mechanism. So how does open banking help small business lending? So this is a key question of my paper. To answer this question, I use the UK's small business focused open banking policy. So this policy was launched by the UK Treasury. And this policy requires large UK banks to share their small business customer data with other banks or other lenders. And specifically, it applies only to small firms with revenue up to £25 million, which means firms on below this threshold, they can share the data through open banking. So this creates a quasi-random assignment of firms' eligibility to share the data, right? Because of this unique setting, I use a regression discount design. I know it's a jargon in academic, but so basically it can examine the causal effects of the open banking. Using a novel administrative data set covering the universe of UK firms and capturing the entire UK security business loan market, I find that open banking facilitates the use of assets like account receivable and inventory as collateral. So these assets, they were previously seen too risky or too difficult to monitor, right? So in other words, means open banking reduces the lender's requirement for the security of the collateral when supplying credit. And also I find that it has no impact on the use of fixed assets. And these effects are more pronounced for firms facing great information asymmetry and for those with great information available to share. Overall, these findings highlight that open banking reduces collateral constraints by mitigating information asymmetry, which in turn improves access to credit for small business. Before diving into more details, I just want to share some instant background about the UK because that may be different to the US or other countries. Okay, so in the UK, there are two types of collateral are used in secured business loan market. So one is floating lien, another is non-floating lien or fixed lien. A floating lien covers general categories of assets as a whole, like current assets, current receivable and inventory. These assets may fluctuate significantly in quantity and value. And most importantly, it can be sold without the lender's permission, right? And another is a non-floating lien or fixed lien. So that lien is tied to a specific asset, like land, property, or equipment. It usually has a stable and a predictable value, and most importantly, it can be sold without the lender's permission. Okay, now we know that many small firms, they have loads of current assets. They don't have many fixed assets, right? But using current assets is a challenge for them. So you can see from this chart, from the left-hand side, you can see the correlation between the size of fixed assets and the use of fixed liens is positive correlated, right? Which means if you have more fixed assets, you are more likely to use fixed liens as collateral. Well, on the right-hand side, you can see there's almost a zero correlation between the size of current assets and the likelihood of using floating liens. In other words, having more current assets doesn't really increase a small firm's chance of using floating liens as collateral. So why is that case? Why? Well, there are two possible reasons. So one, adverse selection problem. Because firms with low quality or highly volatile assets are more likely to seek credit, right? There's also an issue about moral hazard because the assets under the floating liens, they can be sold without the lender's permission. As a result, without up-to-date and detailed information about the firm's operations and transactions, the lenders are not willing to accept these kind of assets as collateral. And this is where exactly open banking can make a difference. There are two roles of open banking. First, it can enhance loan screening, because open banking provides the lenders a rich picture and a better understanding of the borrower's creditworthiness. This substantially improves the default predictions, right? Therefore, the perceived risk is reduced. So that can mitigate the adverse selection problem. The second is it can enhance or facilitate the ongoing monitoring, because open banking gives access to the borrower's data even after the loan has been approved. So this allows the lenders to monitor the borrower's ongoing cash flow more effectively, and it can address the moral hazard issue. So because the data can mitigate both ex-ante and exposed information asymmetry problem, so I say that the data can serve as a form of a digital collateral. Okay, so because so far they're all theoretically, right? To empirically study the cause effect of open banking, we need the data. So for data, I've got a unique data from the Financial Conduct Authority, because I worked there for 2 years just to get the data. So it includes the loan level data and the fund level data. So they are like capturing the entire UK firms and the entire UK secured business loan market. Okay, so this is the key result. So from the left-hand side, you can see there's a discontinuity, huge discontinuity around this cutoff. That means open banking leads to more use of float liens. Right on the right-hand side, you can see there's no discontinuity. It's flat, right? So which means it has no impact on the use of non-floating liens. In other words, open banking reduces collateral constraints. And you may wonder, okay, if there's like a discontinuity already before the policy, right? So I can assure you that in the absence of banking, before the banking policy, the firms just above and just below this cutoff, they exhibited similar patterns in the use of collateral. Okay, just to live up to the stereotype that we academics are very rigorous, so I need to show you the robust check here. So basically, it shows my results hold across all different model specifications. Okay. I think for the interest of time, I've skipped the why part. I know, but this is a very important part. If you are interested, just please take a look at my paper. Okay, so to conclude, this paper put together a novel data set that covering the universe of UK firms and capturing the entire UK secured business loan market. I document that open banking is the pledge of assets like account receivable and inventory. Firms eligible to share the data are more likely to pledge such assets as collateral. And what we already know is that open banking, because it's data sharing, it definitely reduces information asymmetry and boom, more access to credit, right? But what we don't know is the underlying mechanism. And this paper exactly fills this gap by showing that open banking reduces collateral constraints by mitigating information asymmetry, which in turn improves access to credit. Okay, for the last 1 minute or 2 minutes, I just want to show you some vision of open banking. So as of last year, this time, around 90 countries in the world are implementing or actively developing the open banking framework, right? And this is open banking is just the beginning. Now, open banking has been involved into open finance. So that is not just sharing your banking data, but also sharing your investment data, pension data, insurance data, and mortgage data. So what would that happen when the data sharing applies to all financial data? How does this open flow of information spark innovation, reshape competition, and affect welfare? I think, well, there's a very interesting agenda, right? And the UK will be implementing the open finance next year. And China actually is far beyond, because there's already like open data in China. So they are developing an open data infrastructure in the next 4 or 5 years. Okay, because now we are in the US, so I have a slide specifically for the US. So there's a huge regulatory uncertainty in the US for open banking. Even though we have this section 1033 of the Dodd-Frank and also the CFPB rule that it requires the financial institutions to make certain data available to consumers and third parties. But I don't think that it is started, right? Because due to the some government movement or federal change, okay? So basically, the fintechs and some small banks favor it, while the large banks didn't like it. Hopefully, we don't have some guy from large banks, right, here? Because after all, this is community bank conference, right? Yeah? Okay, good. Okay, I know government board here, and also we have many regulators, policymakers, but I'm not making any policy recommendations. The key to the success of open banking is the governance. Like the UK, the small business focused open banking was launched by the UK Treasury. And the general open banking framework is led by a joint regulatory committee by the Bank of England, Financial Conduct Authority, payment system regulators, and other regulators. So it wouldn't surprise me if in the future there will be a regulatory committee in the joint regulatory committee in the US, led by the Federal Reserve, CSBS, and FDI, and the SFBP. Okay, yeah, so that is what I want to share with you today, and hopefully you would enjoy it. Thank you for your time and attention. Thank you.